Hi everyone, this is a video on fixed rates versus floating rates in mortgages. This is a part of a series of educational videos for private investors like you that discusses big issues that come up in managing your investments and increasing your family's wealth for the future. So, fixed rate versus floating rates. Now, let's take an example. So Steve's got a $600,000 mortgage. He took out their mortgage a few years ago with one of the big banks. And when he did, he negotiated a 100 basis point discount to their standard variable rate, a 1% discount to their standard variable rate. The problem for Steve is that the standard variable rate of his bank has only fallen to 4.8%. So he's paying 3.8% on his variable rate mortgage. But he can see in the mortgage market that new variable rate mortgages are going as low as 2.85%, and 5-year fixed rate mortgages are going for 2.9%. So seeing that, he thinks, I'm definitely going to refinance. So that's off the table. He's definitely refinancing. The question that Steve's pondering is, should I go for a floating rate mortgage when I refinance, or should I go for a 5-year fixed rate mortgage? And he's looking at the 2.85% on floating rate mortgages and the 2.9% on 5-year fixed rate mortgages. And he's thinking, why wouldn't I fix? If I could fix for 2.9, why would I go for floating for 2.85? Now, Steve's got a misconception here. What he's missing is that those two interest rates being the same means that the markets think that floating rate mortgage rates are going down. And ordinarily, the markets are right in these things. Those two interest rates being the same means that the markets think that interest rates are going down. And if interest rates do go down, Steve will regret fixing at 2.9%. Now, to understand this a little bit, let's turn to this diagram. And what we can see in this diagram is on the x-axis, the years fixed, and on the y-axis, interest rates. And you can see that when you fix for a longer period of time, ordinarily you have to pay a higher interest rate. And the difference between 5-year fixed and 1-month fixed, that's a standard variable rate mortgage, is through the sweep of history, that's averaged 80 to 100 basis points. That's just a reflection of the fact that when you fix your mortgage rate, you're passing interest rate risk to the bank. And if you pass interest rate risk to the bank, then the bank needs to get something in compensation. What we can also see here, of course, in the red dots is the rate at which the bank itself can borrow money that it passes on to Steve. And below that, the rate at which the government can borrow money. That rate's called the yield curve. And the yield curve, just like the rate at which Steve can borrow money, the bank can borrow money, usually slopes upwards. But at the moment, as we can see here in the graph, at the moment the yield curve is very flat. That's unusual, but that's how it is at the moment. The rate set by the Reserve Bank on the left-hand side, the cash rate, 0.75%, the rate at which the government can borrow money in the market for 5 years, also 0.75%. Ordinarily that would float upwards. And what it means is that the market is expecting that the Reserve Bank will cut rates to 0.25%. Now, Steve needs to take that into consideration. The markets think that rates are going down, and if they go down, after he's locked in at 2.9%, he'll regret it. But Steve's also got to think, well, what will happen over the full 5 years? So, yes, rates might go down in the short term, or they might not. The market thinks they will. Rates might go down in the short term, but what will happen after 2 years, 3 years, 4 years, 5 years? Well, Steve should have some comfort in this graph. This graph is showing what's happened to long-term interest rates since the Second World War in the US, in Germany and Japan, and the same graph for Australia is very similar. So interest rates rose greatly until the early 1980s, and since then they've been falling down, down, down. In fact, here we can see what happened to interest rates in Australia in the last year. And the global forces that have been forcing interest rates down, they're not easily reversed. They are global population aging, the entry of hundreds of millions of new workers into the global economy, and the march of technology. Those things won't be easily changed. So Steve should have comfort in the idea that the probability of rapid rises in interest rates after he goes for a variable rate mortgage is relatively low. Now, another important thing for Steve is, it's one thing what the markets think is going to happen, but he needs to match that to his own personal circumstances. So two people looking at the same things in the markets, same interest rates, might make different choices about variable versus fixed because they have different personal circumstances. So if Steve's very risk averse, then he's going to want to fix his mortgage. He's going to want to pass that risk to the bank. It's also true that Steve needs to think about how he would manage a rise in rates. Does he have two incomes in his family? Does he have extra income that he could draw from somewhere else to manage increased rates? If he does, then it's easier for him to have a floating rate mortgage. Okay, so let's wrap up here. First thing, Steve thinks that the fact that floating rates and fixed rates are almost the same at the moment means it's a no-brainer to go for fixed rates. That's not right. That actually implies the market thinks that floating rates are going down. Second thing, Steve should feel comfortable about what's happened to global interest rates in the long run. It won't be easy for global interest rates to start heading upwards. Downward pressures are long-term and very large, and that should give him comfort about a floating rate as well. Third thing, everyone needs to match their personal circumstances to what they can see in the markets. Now, these kind of questions and many more are fully discussed and explained in my investments course, which is called Finance Education for Investors. It's a comprehensive course on personal investing. It starts from the beginning, so no prior knowledge is needed, but it treats all the important topics in depth. It's not mathematical, but it gives investors the investment philosophy, the knowledge, the processes to be empowered in their investing and to get to much better outcomes. It is education and not financial advice. The course runs for 8 evenings. This video runs for 8 or 9 minutes, but the course runs for 22 hours. So imagine how much you'll learn if you take your place in the course. In any case, I hope you've enjoyed this video and that you'll watch the other videos in this series.